It's a Wednesday evening, you're waiting at a stoplight, humming along to the radio, when your phone buzzes. It's a notification from your insurance company. Your 6-month policy is up for renewal, and your premium is jumping by 14%. You blink at the number, trying to figure out what changed. No accidents in nearly a decade. No speeding tickets since your college days. You drive a practical sedan, not a flashy sports car. You take the same route to work every morning. You're the definition of a cautious driver, the one friends tease for actually using turn signals every single time. So you call the insurance company. The rep gives you a vague spiel about risk factors, and market conditions, and updated actuarial models. You push for specifics, and they finally say it's based on your profile. Your profile? You're a spotless driver. What profile could possibly justify a 14% hike? Here's the kicker, your coworker, who rear-ended someone last year, just got his renewal notice. His premium only went up 4%. Same insurer, same city, same coverage levels. He caused an actual accident, yet he's paying less than you. The difference? He lives in another zip code, has a college degree, and a stronger credit score. None of which have anything to do with how safely he drives. My name is Della, and I spend far too much time uncovering the supposedly objective systems that quietly drain money from people who can least afford it, all while pretending it's about fairness and data. If you've ever stared at your insurance bill wondering why the math doesn't add up, or been told rates are purely about risk when your perfect driving record suggests otherwise, hit that subscribe button and give this video a thumbs up, because what I'm about to reveal will completely change how you think about car insurance. Most people assume car insurance rates are determined by how you drive. Makes sense, right? Insurance is supposed to cover the risk of accidents. Safer drivers should pay less, riskier drivers should pay more. That's the deal we think we signed up for. Drive carefully, avoid accidents, follow the law, and you get rewarded with lower rates. Except, that's not how the system actually works. And the industry has spent millions making sure you don't understand the real formula behind what you pay. Let me introduce you to Sam. He's 39 years old, works as a courier, and has been behind the wheel for nearly 2 decades without a single blemish on his record. No speeding tickets, no fender benders, no claims. His driving history is so spotless it's practically invisible. He drives a 2016 Honda Accord with 125,000 miles on it, nothing flashy, and he's stuck with the same insurance company for 7 years because he believed loyalty would earn him better rates. Last month, Sam opened his renewal notice and nearly dropped it. His premium shot up from $145 a month to $182. That's a 25% increase in 1 year, an extra $37 per month, or $444 more per year, for a driver who has never cost his insurer a single dime in claims. Sam called to ask why. The representative told him his rate was adjusted based on updated risk modeling. When he asked what risk they were modeling, given his perfect record, they said it was based on multiple factors: his credit score, his zip code, and his occupation. Think about that. His credit score, his neighborhood, his job, all things that have nothing to do with how safely he drives. Yet they're perfectly legal for insurers to use when setting rates. And this is where the scam becomes obvious, because those factors aren't random. They're systematically designed to squeeze more money out of people who are already stretched thin. Here's what Sam learned. The company looked at where he lives, what he does for work, and what his credit report says, and decided that makes him a higher risk driver than someone who actually caused an accident. That should make zero sense. But it makes perfect sense once you realize insurance companies aren't pricing based on driving risk, they're pricing based on what they can get away with charging you. Let me show you the numbers that prove this isn't about safety. A 2023 study by Consumer Reports analyzed over 2.5 billion car insurance quotes across major insurers and found that drivers with excellent credit pay an average of 70% less than drivers with poor credit, even when controlling for driving record. Same car, same coverage, same accident history. But if your credit score is below 650, you're paying almost 70% more than someone with a score above 750. Now explain how paying your credit card bill late makes you more likely to run a stop sign. It doesn't. And the insurers know it doesn't. What they care about isn't accident risk, it's price sensitivity. People with lower credit scores have fewer options, less ability to shop around, and less ability to pay upfront for 6 months of coverage to get the discount. Which means insurers can charge them more without losing their business. Zip code has an even bigger impact. A driver with a perfect record living in a predominantly black or Latino neighborhood can pay more than a driver with a DUI living in a predominantly white suburb. Sam lives in a zip code that's 70% black, with a median household income of $42,000. His insurance is 61% higher than identical coverage in a zip code just 20 minutes away that's 82% white with a median household income of $79,000. Same city, same insurer, same coverage, but because Sam lives where he can afford to live, he pays thousands more over time. Occupation is the third piece of this puzzle. Insurers charge different rates based on your job, supposedly because certain professions correlate with different risk levels. Sounds reasonable until you see what actually happens. A study from the Consumer Federation of America found that professionals like doctors and lawyers pay significantly less than service workers like delivery drivers, even when controlling for income and driving record. Sam is a courier, which means he's on the road more than most people. You might think that justifies higher rates. But his coworker, Ethan, is a software engineer who commutes the same distance and works from home 2 days a week. He actually drives fewer miles than Sam. Yet Ethan pays 43% less for insurance. Same mileage, same perfect record, but Ethan's job is coded as lower risk because he wears a button-down shirt instead of a uniform. Add it all up, Sam has a credit score of 640 because of medical debt that went to collections years ago. He lives in a zip code insurers label a high risk. He works a job coded as higher risk. None of these factors predict whether Sam will cause an accident, but all of them predict that insurers can charge him more without him leaving. Sam pays $182 per month. Ethan, with the identical driving record but better credit, a whiter zip code, and a white-collar job, pays $104 per month with a different company. That's a $78 difference every month. Over a year, that's $936. Over 10 years, that's nearly $9,400, money Sam could have invested, used to improve his credit, or saved for a down payment on a home in a neighborhood where his insurance would be cheaper. Instead, it goes straight into the insurer's pocket. Now, let's zoom out and look at the bigger picture. What's happening to Sam isn't just bad luck, it's part of a system designed to maximize profit by charging more to those with the least ability to fight back. Take discounts, for example. Insurance companies love to advertise safe driver discounts, accident-free discounts, or loyalty rewards. Sounds like you're being rewarded for good behavior, right? Not really. What's actually happening is that insurers set a baseline rate that's already inflated by factors like credit score, zip code, and occupation. Then they shave off a percentage and call it a discount. Sam gets a 15% safe driver discount, but that's 15% off a rate that's already 61% higher than it should be. He's not being rewarded, he's just paying slightly less of a penalty. And then there's the loyalty trap. A 2022 study from the National Bureau of Economic Research found that customers who stay with the same insurer for more than 6 years pay an average of 24% more than they would if they switched. Sam thought sticking with his company was smart. In reality, he's being punished for loyalty. He's paying $182 per month when he could probably find the same coverage for $138 if he shopped around. That's $44 a month, over $500 a year, gone simply because he trusted his insurer. The historical context makes this even more infuriating. Using zip codes and credit scores isn't some modern innovation, it's a continuation of old discriminatory practices under a new name. Back in the mid-20th century, insurers could legally deny policies to black families or charge them more explicitly based on race. When that became illegal in 1968, the industry found race-neutral factors that produced the same disparities. Zip code is the clearest example. Neighborhoods in America remain segregated largely because of decades of redlining and discriminatory housing policies. So when insurers charge more for certain zip codes, they're effectively charging more based on the racial makeup of that neighborhood. They claim it's about claims data and risk modeling, but when the zip codes with higher rates are disproportionately black and Latino, even after controlling for accident rates, it's hard to ignore what's really happening. Credit scores work the same way. Black and Latino families, on average, have lower credit scores than white families because of the racial wealth gap created by generations of housing, employment, and financial discrimination. So when insurers use credit scores to set rates, they're punishing people for being victims of systemic inequality while pretending it's just objective math. Occupation adds another layer. White-collar jobs are coded as lower risk, while blue-collar jobs are coded as higher risk, even when the actual driving exposure is the same. Sam's coworker Ethan drives fewer miles but pays far less simply because his job title signals privilege. Put all of this together, and you see the pattern. Insurance companies aren't measuring driving safety. They're measuring financial vulnerability. Lower credit scores, lower incomes, and certain zip codes all signal to insurers that they can charge more without losing customers. It's not about who's most likely to crash, it's about who's least likely to fight back. So what can you actually do about this? Because the reality is frustrating, you're legally required to have insurance, but the system is designed to overcharge you unless you fight back. First, shop around. Don't assume your current company is giving you the best deal. Sam once spent an entire Saturday comparing quotes from 12 different insurers. For the exact same coverage, rates range from $122 a month to $255 a month. That's a difference of more than $1,500 per year, same car, same driver, same coverage. He eventually found a company that offered him $132 per month, saving him $50 compared to what he was paying. But it took hours of digging, calling, and reading fine print. Exhausting, yes, but worth it. Second, challenge the rating factors. Some states have already banned or limited the use of credit scores in insurance pricing. California, Hawaii, and Massachusetts don't allow it, and other states are considering similar laws. If you live in a state where credit-based insurance scoring is still legal, contact your state insurance commissioner and legislators. Push for reform. There's no logical reason why your credit history should affect your car insurance rates. The only reason it's still legal is because insurers spend millions lobbying to keep it that way. Third, improve your credit score if you can. Not because it's fair, but because it's the reality. Pay down high balance cards, dispute errors on your credit report, and set up automatic payments so you never miss a due date. Every point your score rises can save you hundreds of dollars a year on insurance. Absurd, but true. Fourth, factor insurance costs into where you live. If you're already considering moving, check the insurance rates for each zip code. A neighborhood with rent that's $60 cheaper might actually cost more overall if insurance is $80 higher. Total cost of living includes the insurance penalty tied to your zip code. Fifth, don't blindly trust bundling. Sometimes combining auto and home policies saves money, but sometimes it doesn't. Do the math every time. Insurers market bundling as a guaranteed win, but it's just another tactic to keep you locked in. Sixth, set a reminder to shop around annually. The loyalty penalty is real. Rates creep up year after year, and the only way to avoid it is to constantly threaten to leave. It's annoying, but it's the system we're stuck with. Finally, join advocacy groups. Organizations like the Consumer Federation of America, Center for Economic Justice, and United Policyholders are fighting to ban discriminatory rating factors and demand transparency. The more people who support these efforts, the more pressure there is on lawmakers to act. Here's the bottom line: insurance rates have almost nothing to do with how safely you drive. They have everything to do with how successfully companies can segment you into a demographic they can overcharge. Sam pays more even though he's a perfect driver because the system isn't designed to reward safe driving, it's designed to identify who can be charged more without leaving. Every driver with a spotless record who's paying inflated rates based on credit score, zip code, or occupation is being robbed in slow motion. And the robbery is legal because insurers have convinced regulators that discriminatory pricing is just sophisticated risk assessment. The question isn't whether the system is fair, it's whether you're going to keep paying the poverty tax or fight back. Shop around. Demand reform. Refuse to accept this as normal. Because the only way this changes is if enough of us stop playing along. So what can you do? Shop around annually. Rates vary wildly. Sam found quotes ranging from $122 to $255 for identical coverage. Challenge rating factors. Push your state legislators to ban credit-based insurance scoring. California, Hawaii, and Massachusetts already have. Boost your credit score. Every 20-point bump can save hundreds annually. Factor insurance into housing decisions. A cheaper rent in a high-risk zip code may cost more overall. Don't blindly bundle. Sometimes splitting policies saves more. Leverage group discounts. Alumni networks, professional associations, even Costco offer deals. Switch often. Use introductory rates to your advantage. But let's go deeper. Behavioral pricing. Insurers track whether you shop around. Frequent shoppers get lower rates. Loyal customers get gouged. Digital footprint. Online quotes often cost less than phone quotes. Why? Online shoppers are coded as price sensitive. Marital status and gender. Married drivers often pay less, not because they're safer, but because insurers assume financial stability. Device tracking. Usage-based apps collect massive data. They can reward safe driving, but also justify higher rates later. Innovative hacks. Rotate between online, phone, and broker quotes. Check rates across zip code borders. Register a side business. Some insurers give discounts to business owners. Pay premiums with a cashback card, 2 to 5% back on thousands annually. Here's where the real power lies, turning insurance savings into wealth. Save $50 per month, invest in an index fund at 8% growth, that's $9,000 in 10 years. Switch annually, save $400 per year, invest in a Roth IRA over 20 years, that's $20,000 plus. Build a $2,000 emergency fund, pay for minor repairs out of pocket, avoid claims, keep premiums lower long term. Factor insurance into moving decisions, as $60 cheaper rent may cost $80 more in insurance. Every dollar you save isn't just avoiding a penalty, it's fuel for your financial freedom. Insurance companies thrive on confusion, loyalty traps, and discriminatory algorithms. But once you understand the game, you can flip it. The real hack isn't just lowering your premium, it's redirecting those savings into investments that compound over time. Sam's story shows the system isn't designed to reward safe driving, it's designed to identify who can be charged more without leaving. But your story doesn't have to end the same way. You can shop smarter. You can fight back. You can turn every dollar saved into a stepping stone toward financial independence. The poverty tax only works if we accept it. Refuse to play along. Refuse to be overcharged. Refuse to let insurers dictate your financial future. Because the truth is simple, your driving record doesn't define your wealth, but your choices do. Because the truth is simple, your driving record doesn't define your wealth, but your choices do. And maybe that's the biggest lesson hidden inside this entire story. Most people think financial success is built by making one brilliant investment or discovering some secret opportunity nobody else knows about. We imagine wealth as something dramatic, a lucky stock pick, a booming business, or a sudden promotion that doubles our income overnight. Those stories make great headlines, but they rarely describe how real financial freedom is created. Human psychology is remarkably predictable. Most people won't fight over a $5 increase. They won't spend an afternoon researching alternatives to save $40. They certainly won't read through 20 pages of policy language looking for hidden pricing models. Businesses understand something fascinating about human behavior. People react emotionally to one large expense. But they adapt surprisingly quickly to dozens of small ones. Raise someone's rent by $1,000 overnight, and they'll notice immediately. Increase 5 different monthly bills by $20 each over the course of a year, and many people won't even realize they're paying an extra $1,200 annually. One by one, these decisions become permanent, not because they're still the best choices, but because changing them requires effort. And effort is expensive. Not financially. Mentally. Psychologists call this status quo bias. Our brains naturally prefer keeping things the way they are, even when changing them would clearly improve our situation. It's why people stay in expensive gym memberships they haven't used in months. It's why millions continue paying bank fees they could avoid with a different account. It's why investors hold losing stocks for years, because selling forces them to admit a mistake. And it's why insurance companies know many customers will accept annual increases rather than spend 2 hours comparing quotes elsewhere. Financial independence isn't usually built overnight either. It grows from dozens, sometimes hundreds, of small decisions that, on their own, seem almost too insignificant to matter. Until one day you look back and realize those small decisions completely changed your financial trajectory. And that's where the real opportunity begins. Because once you stop seeing insurance as just another bill, you begin seeing every recurring expense through an entirely different lens. You stop asking, how much does this cost? And you start asking something far more powerful. What is this money no longer able to do for my future? That single question changes everything.